Good Monday morning, 30 minutes to start the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, stocks drift while oil drops as Iran claims major progress after all-night talks with the U.S.
And in the UK, Starmer resigns as Prime Minister, paving the way for Britain's 7th leader in a decade.
And SpaceX is looking to raise billions more to fund its AI ambitions, kicking off its first ever investment-grade bond sale.
And that's what I'm looking at the open. SpaceX is falling again, not necessarily because of the bond sale. It was already dropping. Let me show you what it is doing. 4 and about a 0.25%. SpaceX is down, dropping for a third straight trading day. But chip stocks, those are getting a big boost. Micron up 5%, Intel up 3%. The Philadelphia Semiconductor Index closed at a record on Thursday before the long weekend. Micron earnings in a very kind of nothing is going on week. That seems to be the pillar holding.
It feels like nothing is going on.
But then also everything is going on.
There's so much, especially from a macro perspective.
Yes.
We're going to touch on the death of Alan Greenspan. I'm looking at Chevron signing a 20-year deal with Microsoft to provide power for a West Texas data center opening in 2020. Microsoft shares are off a little bit in the pre-market. Chevron shares are up a little bit as well. But that's one of the deals we're focused on. Really doesn't compare with the SpaceX, with the hype of SpaceX's bond sale, does it?
Yeah, exactly, because it's not just this equity market that's dealing with more supply from SpaceX. It's the bond market selling investment-grade bonds for the first time in what's expected to be the start of a massive borrowing spree. Let's discuss with Bloomberg Tech host Ed Ludlow. Ed, it feels like we were only here a week ago when it came to NVIDIA, this idea, you have a lot of cash. Why tap the bond market? What does it mean for SpaceX to be going into this arena?
Yeah, because SpaceX also confirmed that as of June 19th, it's sitting on more than $100 billion of cash anyway. But for them, it's kind of like a treasury management issue. They're going to use this inaugural bond sale to pay down and refinance existing debt. But there's a big longer-term view, which is that SpaceX is many, many light years away from positive free cash flow. And they are going into a world where they're going to have to spend incredibly aggressively. And this is just one mechanism to keep that balance sheet in the order that they will need for all of the projects that they outlined in the prospectus.
Yeah, I mean, SpaceX, as we heard from Bruce Richards, I think early last week, is just the biggest rising star out there. They had debt at more than 12%, and they've managed to cut that to 4%. I'm guessing this will be around there as well. What's the story with the Microsoft Chevron deal? It doesn't have the hype or the excitement of SpaceX, but it's a pretty big number.
Yeah, it's 2.6 gigawatts ramped up to over time starting in 2028, but for natural gas. And so this is both a kind of sort of common sense story where Microsoft has this commitment of doubling its data center footprint over the next couple of years. For this project in West Texas, they are basically saying, okay, we'll use natural gas as the energy source. GE Vernova turbines is the technology or the power generation, and it's all local. It's all localized. But, 2.6 gigawatts is massive. That's the power consumption of the city of San Francisco. For example. So Microsoft has kind of been in this place where it's walked back prior commitments to sourcing renewable energy or matching the procurement of renewable energy to its use. And Bloomberg's done some reporting about this. So that it's natural gas is super interesting. But you're right that Chevron's kind of feeling the benefit of the story. A lot of this was in the prior Bloomberg reporting.
And Texas is such an interesting story here, right? Because they have 33 gigawatts of planned data center build out. Ed, looking forward to your program, Bloomberg Tech's Ed Ludlow. His show starts at 11 a.m. weekdays. Definitely stay tuned for that. Let's get to the Middle East right now. Brent is trading below $80 a barrel as Iran's foreign minister says major progress was made during all-night talks with the U.S. Vice President J.D. Vance had this to say.
We laid a very good foundation for a successful final deal. The final deal is the house. We set the foundation. We haven't built the house, but we've laid a successful foundation to get to a good place for the American people. This is not a deal that the United States is imposing on the region. This is a deal that the region has desperately asked the United States to put in place.
Joining us now is Bloomberg's Washington correspondent Tyler Kendall. So this is just the very beginning, right? We have essentially 60 days of negotiations to go. But what have we learned so far?
Well, Matt, you're right. This is going to kick off essentially what's going to be a protracted process to get towards a finalized deal. Though earlier this morning, Iranian state media did confirm that the country's president is set to visit Pakistan tomorrow to continue the dialogue in what is considered to be a positive sign for the momentum. We heard from the vice president go on there to say that essentially this weekend was to establish 4 main accomplishments. The first is, as you heard, outline the framework to keep the talks going. The second is this idea of a deconfliction mechanism that would essentially extend the ceasefire to the fighting in Lebanon. He did confirm that Iran did try to walk out of the talks earlier over the conflict there. The third is that Iran will invite inspectors back into the country as soon as this week, according to the vice president. And the fourth is that they established a mechanism to keep communication open regarding the Strait of Hormuz, because we are starting to see that traffic tick up, though, of course, well below pre-war levels. We did hear from CENTCOM on Saturday confirming that 55 vessels carrying 17 million barrels of oil transited through. And new data analyzed by Bloomberg News this morning shows that 4 empty LNG tankers are currently on their way back to Qatar, in the largest number of empty LNG ships that have transited so far since the conflict began. Matt and Dani, one other thing for your radar that caught our eyes, which is that Vice President J.D. Vance seemed to dispute some comments from Iran that assets have already started to be unfrozen. He says that that hasn't happened yet, but when it does, the assets would be linked to the purchase of American agricultural goods, but he didn't give us much clarity on exactly how that component would work.
Tyler, what about this $300 billion fund that's been kicked around? What do we know about that and who would actually pay for the thing?
So at this point, the U.S. has disputed that that's really going to be a main focal point of this. President Trump has said that that's not going to be U.S. money, but perhaps it would come from regional allies. And that he himself wouldn't prohibit anybody from investing in Iran or helping the country rebuild, though the U.S. has said that they are going to be looking for some sort of mechanism here in order to allow the country to rebuild after the strikes. But it really does show just the latest in one of a long list of sticking points at this moment to actually getting this finalized deal over the finish line.
All right, Tyler, thank you very much. Bloomberg's Tyler Kendall in Washington. Now, over in the UK, Keir Starmer stepping down as Prime Minister.
The question my party is asking now is whether I am best placed to lead us into the next general election. I have heard the answer of my parliamentary party to that question, and I accept that answer with good grace. Every decision I've taken has been about putting the country I love first. That is why I will resign as leader of the Labour Party.
Starmer's resignation opens the door for the UK's 5th Prime Minister since 2022 and the 7th in a decade. Bloomberg UK government reporter Joe Mays joins us now from London. And also, Joe, opens the door for Andy Burnham. Does this change at all the trajectory of the UK?
It very well could do. I think that Andy Burnham is expected to lead a government that's perhaps more to the left than we saw under Keir Starmer, perhaps loosening borrowing rules, perhaps taxing and spending more. We'll have to wait and see. We'll see who he appoints as Chancellor, a very important decision for markets, investors watching that very closely. We had Rachel Reeves currently in post, been very disciplined with her management of the public finances. Will Burnham select someone of a similar ilk or someone who might, as I say, borrow and spend more? It's a key question that markets are watching. For now, the immediate focus is Andy Burnham arriving in Parliament today, being sworn in as an MP, and then the question of when might he actually become Prime Minister. We know that the nominations for the leadership contest open on July 9th, and then we expect, if there's no other contender, Burnham could be Prime Minister by, say, July 18th, so sometime next month. So things are really moving quite fast here, and Andy Burnham, as I say, could be Prime Minister in July. He'll have a lot of work to do getting ready for that. Who's going to be his top team? Who's going to be handling the machinery of government? What's his policy plans going to be? Lots of unanswered questions today.
So what are the chances we get at some point new elections and like a Nigel Farage candidacy that has some real heft?
Yes, that's the big claim being made by Nigel Farage today. He is saying we need to have a general election now because we're on course to have a new Prime Minister, Andy Burnham, who does not have a national mandate. He won't have been elected by the British public. At best, he's won a special parliamentary election in Makerfield, the north of England, but he doesn't have a mandate from the wider public. But as for now, Labour's argument, Andy Burnham's argument, seems to be, no, we don't have a new general election. Labour still has a majority in the House of Commons, and that's enough for him to carry on as Prime Minister. But be sure that pressure for a general election will grow, and you can see some arguing that it might be a good idea for Burnham to go for one now. He's probably not going to be more popular than he is at this point in time. So you can see that argument might emerge in Labour circles. These are very uncertain times.
All right, Joe, thanks very much. I'm sure you'll be very busy, continue to be very busy here as you have been all weekend. Bloomberg UK government reporter Joe May is reporting on the resignation of Keir Starmer. Check on markets right now. We're looking at very little change on S&P futures to kick off the week. NASDAQ futures are higher as the chip makers continue to rise. You can see right now the 10-year yield at 4.50. It's really the 2-year yield that's been the most interesting to watch lately and rising the most today as well. Brent crude right now down $1.55 to 79.02.
Yeah, Brent no longer dictating the moves in Treasury. Something else is. Some of the individual movers on our radar, AbbVie buying Apogee Therapeutics, a $10 billion deal that will expand its anti-inflammation product line.
Dublin-based builder CRH is buying U.S. rival Arcosa in its biggest deal to date at $8 billion.
And Getty is surging on an OpenAI licensing deal to bring its photos to ChatGPT. It's up 124%, but that is just 75 cents that it's moving by.
Coming up, Alan Greenspan dies at 100 years old. We'll discuss his legacy next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Meta is investing $900 million in Indian fintech startup Cred, taking a 20% stake and naming the founder Kunal Shah as the new head of WhatsApp. Meta says the move supports WhatsApp's next phase, including AI, advertising, and subscription growth. Morgan Stanley is weighing a $1.3 billion office tower in Dallas, bringing its growing local operations under one roof. The move adds to Dallas's momentum as a financial hub following big investments from Goldman Sachs and Bank America. And former Federal Reserve Chairman Alan Greenspan has died at 100 years old from complications from Parkinson's disease. Greenspan led the Fed from 1987 to 2006, overseeing a long economic expansion, at the time the longest in history, and becoming one of the most influential central bankers ever. His legacy was later clouded, though, by criticism that lax financial oversight helped set the stage for the 2008 financial crisis.
On this, let's bring in Michael McKee, Bloomberg's international economics and policy correspondent. Mike, as Matt mentioned, nearly 2 decades at the Fed and a legacy that was recast yet again in 2008. How do we view Alan Greenspan's legacy here in this year of 2026?
Well, I think you have to call him one of the most, if not the most consequential Fed chairs ever, because he presided for so long over so many different twists and turns in the economy. Shortly after he started in 1987, we had Black Monday and the big drop in the markets. He responded by offering the markets unlimited liquidity, which then became known as that Greenspan put that you had on the screen, the feeling that the Fed will always step in to save the markets. And that's certainly influenced the way that markets have traded and the way the Fed has acted. He presided over one of the longest expansions in U.S. history, in large part because he recognized early that productivity gains from the PC computer revolution would be able to hold down the rise of inflation. But then, as you mentioned, he did miss the housing crisis, dismissing warnings about it, saying that it wasn't going to have an effect, that higher mortgage rates were going to tamp it down. And so that has clouded his legacy in the years since.
I believe it was Ben Bernanke who coined the phrase the great moderation, which I guess is the idea that we had lower inflation, faster growth, fewer recessions, less economic volatility, right, during I guess, Greenspan's tenure. On the other hand, some people have called it the great leveraging because it's like a spring that was coiled up and then just exploded with the financial crisis. And a lot of people point the finger at Greenspan for that.
Well, and don't forget, before the financial crisis, we had the dot-com meltdown. The markets over-leveraged themselves and went a little crazy there. Greenspan recognized that, but didn't do anything about it. He gave, in 1996, his famous irrational exuberance speech. I was there. We didn't realize what he was saying at the time. We didn't have cell phones then. I got home and my answering machine was ringing off the hook with people in Asia calling to ask, what did he say? What did he say? Markets quickly recovered and went on from there to new highs. And then in 2000, that bubble popped. So he had some blind spots as well as some very good economic observations that helped the economy grow.
Reflecting on Greenspan's communication style is an especially interesting journey right now, Mike, considering we're entering the era of Kevin Warsh as Fed chair, who again seems to want to change the way the Fed communicates. Greenspan, of course, was before the era of forward guidance. How has Greenspan and on really changed the way the Fed communicates to these markets and the public?
Well, he really changed everything because he was the first Fed chair to put out a statement explaining what the Fed had done at a meeting. In 1994, he announced that the Fed had raised interest rates and suggested that they might do so again, which led to a huge bond market sell-off. But it became the practice of the Fed to put out statements, and then gradually they expanded what they did to the minutes and to other programs that they announced and they talked about, and it became very much a transparent Fed, much more transparent than in the days when the book was written about them, Secrets from the Temple. So he was the precursor to what we see today. The other interesting aspect of what you said, Dani, is that Greenspan ran that committee. He was the last one to speak. He was the one who decided basically what the Fed was going to do. He had enormous influence. And ever since then, the Fed chairs have attempted to be much more diplomatic, much more inclusive, much less of a force. They try to develop consensus rather than tell people what they're going to do. It'll be interesting to see which model Kevin Warsh adopts.
Yeah, absolutely, especially considering he was essentially schooled, at least at the very beginning, by Alan Greenspan. Mike, thanks so much for joining us. Michael McKee there, our international policy and economics correspondent, spent some time himself with Alan Greenspan, the maybe most influential Fed chair who led the central bank for nearly 2 decades, has died. He was 100 years old.
Morgan Stanley believes that thinning liquidity is becoming a greater risk to markets than potential interest rate hikes, specifically to stocks. Strategists led by Mike Wilson say liquidity is tightening to uncomfortable levels as traders assess the Fed rate path and make changes to the Fed's balance sheet. They also note that Treasury buybacks have been reduced while lending growth is accelerating. Joining us now is JP Morgan Private Bank Head of Alternative Investment Strategy, Sitara Sundar. Sitara, it still feels like the market is trying to decide what to make of last week's FOMC. That was decidedly more hawkish than at least we had been pricing in. How much of a difference did Kevin Warsh at last week's meeting make to you when it came to the trajectory of risk assets?
Look, I think the biggest thing for us that we came into this year thinking about that got, re-emphasized last year is what is the path of inflation going to be, and then what does that mean for rates, and subsequently, does that actually matter for equity markets holistically? I think for us, the one thing that it does bring to the forefront is this idea that inflation volatility and the focus on inflation is going to be of utmost importance over the next, call it 6 to 12 months, especially with Warsh at the head, which I think is honestly positive, because it, I think, reinforced the objectivity and the independence of the FOMC, which I think is a risk-on move and a market-constructive move. But I think the final point for us, really, as it relates to markets moving forward, is this idea that inflation volatility is likely going to be here to stay. So to ensure that your portfolio is constructed in a way that's going to be durable, that you have cash flows in your portfolio that are inflation resilient, infrastructure, core real assets, even less diverse, less correlated return streams like hedge funds, that's become a lot more topical for us over the past few days.
But does inflation really matter that much at 3 or 4% as long as we're getting earnings growth in the double digits?
From a strength of equity market perspective, I would say less so. I agree. A lot of the equity markets moves that we've seen so far this year has been built upon the fact that we've had double-digit earnings growth for the past several quarters now, the longest stretch that we've seen post-global financial crisis. But the part that it does matter for is usually when we've seen inflation levels above 3%, we start to see a positive correlation between stocks and bonds, because usually there's some kind of ramifications for what that means for rates. And if rates end up moving higher in some way, shape, or form, not our base case, but the risk is out there, that could negatively impact stocks and bonds at the same time. So that's what we're thinking of. Less of a concern on the strength of equity markets. We still have a positive outlook over the next 12 months, but more on the idea of ensuring that your portfolio is going to be able to withstand that if stocks and bonds end up being positively correlated over the next 6 to 12 months or longer than that.
Just very quickly, Sitara, I also just wonder if you assume just more volatility, not only because of inflation, but just a less chatty Fed, if Kevin Warsh and the rest of the Fed speak to us less.
Look, less forward guidance is obviously going to, I think, impact rate volatility and equity market volatility at the end of the day, but for us, we're fundamental focused investors, so we'll be most paying attention to what earnings growth is going to say and what bond fundamentals show.
Both Kevin Warsh and Alan Greenspan, fans of a little bit more discretion for the Fed, right?
Yeah, I feel like
less over-communication.
Greenspan was more like having very complicated communication to obscure what was going on, whereas I feel like Kevin Warsh is just less.
Yeah.
But same goal in mind.
All right, Sitara is going to stay with us. We get a check on markets ahead of the opening bell. Look, S&P futures starting to climb now. We'll be back with the bell ringers after this break. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking right now at futures that are starting to climb. Well, no. I mean, unchanged on S&P futures. It's a sleepy Monday morning in terms of the equity indexes. NASDAQ futures doing a little bit better because the SOX index, because the chip makers are starting to rise. You can see the good old Dow Jones Industrial Average futures right up 0.25%. Down at the New York Stock Exchange, this is kind of exciting. Jan van Eck ringing the opening bell, celebrating one of his ETFs, GDX. I think it might be a gold miner ETF. I was just looking on the terminal, and it has actually outperformed its benchmark if you look over 5 years with the comp function and total return. So Jan ringing the bell there. I doubt it's his first time ringing the bell at the New York Stock Exchange. At the CME Group, no Terry Duffy here ringing the bell, but the CME Group bringing out some executives at the NASDAQ marketplace, and they're having a nice time doing a bucket list event.
I always have to assume that they have music playing because everyone is always dancing there.
I hope they have music playing.
Well, they're not really dancing anymore. They were.
Otherwise, it's just a big empty studio.
Yeah,
you know?
true. Yeah,
ding, 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 ding.
Yeah. That's not as much as excitement on the New York Stock Exchange floor, perhaps. At the open, Matt, I am looking at SpaceX. It falls for a third straight trading day. Now it's down 5% at the open. To be fair, though, shares were already down in the pre-market, and then they announced this massive bond sale. They're going to raise billions for AI and space ambitions, even though SpaceX has a lot of cash on its balance sheet. Again, why not tap bond markets now? Because you can, and the cost of capital is cheap.
Are we just going to look at SpaceX every day now?
Yeah,
for
obviously.
The next few weeks?
Yeah.
And then
I think it's necessary. So, I mean, this will not come as a surprise. I was looking at data from Vanda Research that it was the most bought retail offering ever. So, a lot of money on the line, especially from everyday people with SpaceX.
Very good point. Those same people probably hold chip stocks, and we see the stocks higher as the memory chip market continues to tighten. You can see Micron up another 5% as is SanDisk. Intel gaining a little bit more than 3%. Let's bring back JP Morgan Private Bank Head of Alternative Investment Strategy, Sitara Sundaram. This is a perfect place to get your AI take as it stands. I guess chips, memory chips were the latest bottleneck to just explode, right? A lot of those stocks are up 1,000% over the last year, at least Micron. So what's next? Where else do you look for investable opportunities?
Yeah, look, the two biggest bottlenecks that will ultimately lead to opportunity for us. One, I mean, you alluded to this too, is the power and the memory shortages. We have a pretty meaningful supply-demand imbalance still, and what is, even though we're multiple years into this and the amount of capex that's already been invested, we're still in a compute-constrained economy. So whether it's memory, whether it's inference-oriented, or on the power side, trying to bring online, whether it's LNG, nat gas, or even some of the renewable energy sources more globally and internationally, trying to find ways to bring on the supply to meet the demand that's needed to meet the desires and the need from the AI construct is one. Two, that I think is less talked about, but I think has accelerated so far this year, is the application side. I think a lot of folks have been focused on the foundational model layer around the rumors around these mega IPOs that could be coming to market over the next 6 to 12 months. But the other side that we're really focused on is what AI integration into the real economy is really going to look like, because then artificial intelligence starts to become a platform technology that other industries are built on top of in this very similar way to the internet and cloud, where a lot of companies, even if you weren't tech oriented, started integrating AI into their day-to-day processes, and that's where we're focused.
Who's the winner of that? Is that software companies? Who ultimately becomes the steward of that, application layer that companies are built off of?
Yeah, there's two different ways to look at it. One, there are areas that we're looking on the vertically integrated artificial intelligence models, and what that means is these either hyperscalers or bigger companies that are able to invest from the power side, the chip side, and then ultimately the application layer. That's probably, given some of the IPOs that have just happened and the IPOs that are likely going to happen and a lot of the capex that we're seeing, that's one part of it. But then two, when we think about industry specific AI tools, a lot of that is actually happening within the private market still, within the VC and growth space, but these industry-specific tools where you can create large language models that are based on proprietary data sets that have some kind of qualitative and judgment overlay, that you are reworking an entire end-to-end operating system for a specific industry. That is probably where we think the edge and the next edge is going to land versus just the horizontal layers.
Mike Wilson talking about liquidity in this market, and the question I keep asking is, do we have enough cash to fund all of these mega IPOs, right? I mean, if we, as Dani points out, buy, so many SpaceX shares and the biggest retail investment in history, are they going to have enough money for OpenAI? Are they going to participate in Anthropic? Does that money have to come out of a Micron and SanDisk, which, I mean, I would want to take profits if I were up 4,000% in 12 months too. So what do you think about those big IPOs coming?
Yeah, I think that there's a couple of ways to look at it. One, whether or not the public markets are actually going to be able to absorb it. I think the biggest way that we end up thinking about supply-demand dynamics from like a technical perspective within equity markets, there'll probably be some rotation of some of the winners to help fund some of these new companies that are coming. But then the ultimate question is, like, which index is it going to be included in, and therefore where is that funding going to come from? The other is to net the supply and the IPO issuance that's going to come into the market versus buybacks and M&A activity that's already coming. So when we actually look at 2026 and even 2027, we're actually still going to be in a period of time where demand is still outpacing supply, because the amount that's coming through between lockups and the time frame with which supply is going to come into the market, we still think that the public markets are going to be able to absorb it. And the final thing that I think is being talked about less so is this idea of, companies staying private for longer or private forever. Is that entire thesis debunked now, given a lot of these IPOs that are coming into the market? We firmly believe that's not the case. We think that the IPO channel is going to open up for some of these thematic and AI and defense and security-oriented companies. But private capital markets are still big enough at this point in time that there are still a lot of private companies. 85 to 95% of companies with revenue over $100 million are still private. So you can have two things at the same time, and two ecosystems exist at the same time. So for us, from an investment perspective, the need to have both public and private markets, not just in terms of diversification from an AI value chain perspective, but also to even play the issuance that's going to come and who's going to use the public market versus not is really important.
Speaking of private markets, Sitara, how have things been and how have your clients' attitudes been recently around private credit? The worst of the headlines has slowed. You still see every now and then, only a couple weeks ago, Blackstone redemptions exceeding the 5% cap, Cliffwater again. How are your clients currently feeling about it? Is there still some nervousness around it, or has there been a little bit more calm?
I think that they're approaching it in a balanced way, in part the same way that we're approaching it, which is what is the role that private credit and specifically direct lending, because that's what's caught a lot of the headlines right now, play within my portfolio. And the idea that direct lending yields have normalized quite a bit and that the yield premium versus what you're getting in public extended credit markets has compressed. You're still getting about 150 basis point, if not more, given spread widening so far this year, premium. Part of that is compensating you for the increase in default risk that is within the market right now, but you're still getting a yield premium. What has shifted so far this year is a re-emphasis on this idea of complementing that direct lending exposure with other areas of the private credit and public credit markets where you don't always have to reach down the credit quality spectrum to get that additional yield. So asset-backed finance is starting to become a lot more topical of a conversation. You have visibility into a cash flow perspective. At the end of the day, you are lending against a hard asset versus corporate revenue streams, which also gives you a certain durability and visibility. And the other side of it, private credit is a bigger ecosystem than just direct lending, and opportunistic and distressed opportunities are picking up too.
Sitara, thank you so much for joining. Always wonderful to have you on. JP Morgan Private Bank Head of Alternative Investment Strategy, Sitara Sundar. All right, about 10 minutes into your trading day, and it's an equity market that's being led by the chip makers. We're up 1/3%, though we do need to gain about 1.5% in order to reach another all-time high. Micron carries the mantle this morning. They're going to be reporting earnings after the bell on Wednesday, but it gets a boost today after announcing a partnership with Anthropic to build AI infrastructure, and you can imagine that it rallies after that, and it does. We're up more than 5.5%. A good day for the other chip makers, Micron, Intel, SanDisk. AbbVie is also up a lot, a little bit of M&A. They're buying something. Again, the rest tend to be chip makers here too. On the downside, the Mag 7 has been doing so poorly, and that's, again, what leads us to the downside this morning. Maybe if you need to make space in your portfolio for SpaceX, the Mag 7 looks like a good place to sell. By the way, the Mag 7 down about half of 1% year to date, while the overall market has been up. So it has been a clear laggard. It is not the outperformer for this market anymore. When it comes to sectors, communications are down because of what the Mag 7 is doing, but infotech leads because of Micron and the other chip makers, followed by healthcare, financials, and industrials. Matt.
All right, interesting look at the markets. We get off to kind of a slow start in the equity index for the week. Coming up, AbbVie strikes an $11 billion biotech deal. We'll give you the details of that next. You can see Apogee Therapeutics up almost 50% in the early trade. This is Bloomberg Open Interest.
Let's check in with the sell side and get you some top calls this morning. First up, Morgan Stanley has cut Cleveland Cliffs. They say higher steel prices are now reflected in the stock. Shares drop 1.75%. Next up, GF Securities. They upgrade Supermicro to a buy in its clear AI server demand and accelerating SpaceX orders that are expected through 2027. Finally, Wall Street weighs in on AbbVie's nearly $11 billion purchase of Apogee Therapeutics. They see the deal as a strategic fit for AbbVie's ambitions. Stifel says that the timing works, and Wedbush calls the tie-up attractive. Matt.
So attractive. All right, let's get more details now from Sam Fazeli, Director of Research for Global Industries and Senior Pharmaceuticals Analyst at Bloomberg Intelligence. And this is, something that I find fascinating because it's a psoriasis treatment that Apogee makes, right? Skyrizi, we've all seen the commercials where you're not exactly sure what the disease is or what the cure is supposed to be. Is this like something that works? Or is it a problem that's very difficult to fix?
So, Matt, folks who suffer from psoriasis, I have had colleagues who have plaque psoriasis on their arms or other parts of the body. It's an awful disease. It's an inflammatory disease of the skin. And that's where AbbVie has already been very successful. Its old drug Humira was used in that setting, but mostly in rheumatoid arthritis. There are similar kind of mechanisms involved in all these inflammatory diseases. And then now, of course, Skyrizi is a big one there. What they're acquiring today is ectopic dermatitis, known to mere mortals like you and I as eczema. And that is where you get endless itching and you get flaking of the skin. It's not quite as inflammatory as psoriasis, but that's what they're buying today, where they can add to their portfolio, particularly after 2030, because this drug has even not started phase 3 trials yet.
So if Skyrizi for AbbVie before was their blockbuster medication, Sam, how do these companies like AbbVie analyze and look at portfolios of what they're acquiring to try to pick out what could be the next blockbuster? What are sort of the characteristics that someone like an AbbVie would look for?
I think what they've gone for here is the fact that this is a treatment that you can take possibly every 3 months or even every 6 months. It's an injection, but every 6 months, and you're somebody who suffers from itchy skin, that really does interfere with your normal life. You know, you can get very severe ectopic dermatitis, eczema. You end up in a situation where this kind of therapy you don't have to take every day. You go and get your shot every 3 months or 6 months, or maybe even deliver at home. You've got a situation where you've really are helping the patient significantly here. Other drugs, the key one that they'll be competing with, if they succeed in phase 3, is Sanofi's Dupixent. Of course, Sanofi had its own news today, changing the head of R&D. So that share price is under pressure here with AbbVie, who is a behemoth in the world of immunology and inflammation.
How big is this market, Sam? I mean, eczema and psoriasis seem like really fairly common diseases.
They do. And then add to that rheumatoid arthritis, add to that Crohn's disease, add to that ulcerative colitis. These are significant burdens on society and folks who suffer from them. And I think, you know, if you look at the numbers for AbbVie, you can easily see $50–60 billion forecast by analysts and us just for the 2 drugs that I have today, Rinvoq and Skyrizi. Add this to it, you know, I mean, Dupixent, which is the competing drug from Sanofi, is heading to $25 billion.
All right, Sam, thank you very much for that. Appreciate it as always. Sam Fazeli of Bloomberg Intelligence. Coming up on the show, Treasury steeping across the curve as the Fed puts price stability front and center. We're going to discuss that next right here on Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on at the index level. A few minutes into the session, we are up on the S&P 500 to 7520, 7521, so a gain of about 0.3% in the cash trade. The Nasdaq gaining 0.5% right now, pushed higher by chip makers. We also see yields right now, well, rising a little bit. The 10-year at 4.50, so that's a 4 basis point gain. Brent crude, though, coming down 3.5%, 77.69 for a barrel of Brent. Nvidia is higher, and chip makers, you can see Micron and Intel also gaining right now. But SpaceX is 8% down this morning on news of a bond offering. I mean, we kind of expected that, and it's still trading at $170. If you got it at 135, you're still a happy camper. Getty Images has doubled in value, but it's kind of a penny stock, or certainly was, after a deal with OpenAI to use some of Getty's pictures, photographs, maybe all of them. And then Apogee Therapeutics, we just finished talking about getting taken out by AbbVie. The gain right now, 47%. Dani?
A very solid deals Monday. Throughout the week, though, investors are going to be focused on May's PCE data. It is expected to show faster monthly and annual inflation, which may reinforce the case for rate hikes. The eco calendar also includes key data on manufacturing activity, new home sales, and consumer sentiment. We've also got some Fed speakers. That includes John Williams and Kashkari. And that will also be a focus for markets as they look for fresh clues on the outlook of monetary policy after Kevin Warsh's first Fed meeting. Bloomberg macro strategist Michael Ball worked at the New York Fed and joins us now. Mike, I just wonder, you know, today feels particularly telling. 2-year yields are up 4 basis points, despite the fact that Brent crude is down 3.5. Is the driver for yields now longer oil and what's happening in Iran and us evaluating the new direction of this FOMC?
Yeah, in a lot of ways now it's going to be back to fundamental growth stories. Like, this is actually a positive in some ways. Like, we're going to get a more credible Fed who's going to be more focused on inflation, which will help with the affordability crisis and maybe in the long run actually bring yields lower. But right now we're going through kind of a transition phase where the market's going to be sniffing out just how many hikes we think are coming. And, you know, we've had a number of sell-side guys come out over the weekend, say 3 hikes, which maybe makes sense, given where growth is going. Again, we know where inflation is. We know that's the problem. But if we get a stronger growth pulse, not just from this AI CapEx wave, but also from maybe a consumer now that's stabilizing because there's less uncertainty and less shock in their life, then we have actually a good reason to raise rates. And it doesn't mean that risk appetite has to get killed.
I mean, the market is kind of doing it for him, right? If you look at the 2-year yield, it's pretty fascinating. From the end of February until now is just a massive gain. We were at 330, 340 at the end of February, and now we're up at 420 on the 2-year yield. That's a big rise.
Yeah, and this is
financial
conditions tightening in advance of the Fed. It's funny because Wolfe doesn't want this much communication. Well, he was quite loud without saying much, and that statement, being as short as it was probably one of the more hawkish statements we've seen in a long time. And that makes sense because we're in a new era. He's stressing new things. We know he needs to build consensus, and we know he needs to kind of hone the message.
Is it really hawkish, dude, to kick the can down the road with a committee for literally everything, giving yourself an out to make no decision until you can cherry pick an inflation stat that meets your expectations?
God bless Alan Greenspan, what he did for the world in a lot of ways and for central banking. But that's what we're going to find out. Does Wolfe want to be a single man leading, or does he still want a consensus like we saw with Bernanke, Yellen, and obviously Powell? And that's the big question markets are asking, because if it's just him leading the way, then I think we know kind of this will be a more hawkish stance, despite a lot of the dovish worries with him being Trump's pick.
I do wonder, though, if you have a Fed chair, Wolfe, who doesn't want to communicate as much, who talks less. I mean, we're getting Fed speak today still. Is that what just replaces it? And the market then looks to, you know, Kashkari and Williams and whoever else is speaking that day to try to divine where Fed policy is going. No. To what difference does it make then that Wolfe isn't speaking as much? Isn't it just other Fed speakers who will basically do the talking?
And again, look, we're 1 week out here. It was kind of a tectonic shift in a lot of ways that we're all still absorbing. I think you're right. I think what happens is we just listen to a lot of these other guys less, because in the end, we get the general gist that the leadership wants a tighter policy and a more kind of hawkish message into the year end, where we now have inflation and growth as it's more appropriate. It's just the way it is.
And in terms of financial conditions, do they continue to tighten, or will they roll over here?
Well, we'll see. I mean, the dollar is still sort of in this range because of the Iran-U.S. situation that hasn't really come off as much, and we obviously see equities near highs. We see credit spreads near lows. So those are kind of countering the tightening we're seeing from the Treasury curve and from the front end, from tight end going higher, from yields higher up there. So to answer your question, Matt, they're kind of balancing each other right now. If we saw a break in risk sentiment and we saw equities and credit all of a sudden coming off, then you're going to have a situation where they may not need to actually tighten because the market's doing it for them, to answer your question.
Cool. Michael, thank you very much. You can check out Michael's work on the MLive function on your Bloomberg terminal, MLIV, and the work of his colleagues. Coming up in the next hour, Morgan Stanley's Sarah Wolfe joins us on the Economic Outlook. With the Strait of Hormuz nearly reopened, former Fed Governor Randy Kroszner on Alan Greenspan's legacy, plus the CEO of Alamos Gold. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Dani Berger, still sitting below all-time highs as the semiconductor index itself hits an all-time high ahead of Micron earnings this week.
Coming up, oil drops as Iran claims major progress after all-night talks with the U.S.
And in the UK, Keir Starmer resigns as prime minister, paving the way for Britain's 7th leader in a decade.
SpaceX is looking to raise billions more to fund its AI ambitions, kicking off its first ever investment-grade bond sale. But we start with Keir Starmer stepping down after 2 years as the UK's Prime Minister.
The question my party is asking now is whether I am best placed to lead us into the next general election. I have heard the answer of my parliamentary party to that question, and I accept that answer with good grace. Every decision I've taken has been about putting the country I love first. That is why I will resign as leader of the Labour Party.
Former Manchester Mayor Andy Burnham has emerged as Starmer's likely successor. Bloomberg UK government reporter Joe Mays joins us from London. And Joe, to be clear, this is a handoff that will not entail a general election, right? For Americans who aren't completely up to speed with the UK parliamentary system, they just give it to someone else at first.
Yes, that is correct. You don't have to have an election when the party leader changes. The Labour Party still has a clear majority of MPs in the House of Commons, and that remains the case. And so they can change their leader and have a new Prime Minister, but no need for a new election. Now, we must say here that Andy Burnham is likely to be the next Prime Minister, but we could still yet have some kind of contest emerging if someone else wants to challenge him for the crown. But today, key rivals such as Wes Streeting, the former Health Secretary, publicly backed Burnham. And as it stands, we can't see anyone really on the field who's likely to challenge Burnham. So yes, it looks like it will be Burnham, and it could be coming in next month, likely 17th, 18th of July, if there's no other contestant. And yeah, that's where it stands.
The volatility among leaders has been quite stunning, really, post-Brexit in the UK. Joe, how does another leader coming in, the seventh in a decade, yet again set up the trajectory for politics in the UK?
Yes, so Andy Burnham is likely to face all of the difficulties that Keir Starmer was dealing with, and indeed Rishi Sunak before him, and Liz Truss before him, and Boris Johnson before him. You know, UK finds itself in a situation where the public finances are strained, debt levels are particularly high, tax is already particularly high, the economic growth rate has been bumping along under 1%, and voters and politicians are struggling to convince voters that what they're doing is worthy of their vote. And that's why you see the likes of Nigel Farage's Reform UK doing so well in the polls. And I think really what's happened here is Labour MPs have decided Burnham is their best chance at beating Farage, given how well Burnham did in the make-up by-election last week. Burnham showed that he has an offering which could beat the Farage's offering. So that's why we've had this likely change of power here. But Burnham is likely to face all the same difficulties that Starmer faced. So it's really uphill battle for him too.
Joe, thank you very much for your work this morning. Bloomberg UK government reporter Joe Mays. Joining us now to discuss this and much more, Sarah Wolfe, senior economist at Morgan Stanley Wealth Management. Sarah, great to see you this morning.
Thanks for having me.
And look, it's a problem that many nations are dealing with, public finances and how you fund this gap. For the UK, it's meant a lot of leadership changes, and I mean, markets are barely reacting to this in the UK. Like, gilt yields are little change. The pound is different. How are you viewing this political volatility with the lens of just huge budget gaps that these countries are facing?
Well, I would say that public volatility, geopolitical volatility is become kind of the new normal in developed markets. It used to be viewed as more of a normal for emerging markets, and now it's happening in the U.S., it's happening across Europe. The public debt debate has been front and center for us at Morgan Stanley. And what we've said is that it's not going to cause insolvency in the U.S. It's not a near-term issue for the U.S., but it does come into consideration 5+ years from now when we think about how much do we need to pay investors to buy U.S. fixed income, and what does that mean for asset allocation and portfolio construction.
But that price hasn't really risen too much, right? That risk premium.
Not too much. I mean, the reality is that there's not a great alternative to U.S. debt. There's no other markets that are as deep, as liquid, as safe. Even when the conflict with Iran broke out, we saw that money still flowed into the U.S., right? Increased demand for U.S. treasuries. And so we will remain the safe haven asset, but we are encouraging diversification because as the years move on and we start to see Social Security and Medicare get closer to insolvency, that will start to lift the premium.
Well, it was at least first leading two-year yields, the conflict in Iran and higher oil prices. They're up 76 basis points so far in the year. Now you're still seeing two-year yields drift higher, even though it seems like we're approaching something as a resolution. Do you think, and that's probably because of the Fed, but do you think that the war in Iran as a macro driver has kind of ebbed and is fading into the background.
It definitely feels that way for equity markets, right? Fixed income markets are seeing inflation still forefront, and we're seeing that pricing where there's still quite a bit of pricing for a rate hike this year. Whereas equity markets are really believing in this disinflationary story, whether it's oil prices coming down and that bleeding into bringing core inflation lower, but also namely tariffs coming down. And then the biggest part is this AI story, where equity markets are seeing AI and the productivity boom that should come with it as being disinflationary, whereas fixed income markets are a little bit more cautious on that point. And in fact, what we are seeing is that this AI build-out story is going to be inflationary over the near term.
But investors are willing to put up that money for very little risk premium. I mean, money's cheap if you're building a data center in Texas, right? You can get, SpaceX was looking at 12% plus yields, and now they're getting 4%.
This gets exactly at Warsh's point of the unevenness of tightness of monetary policy in the economy.
I also thought that was one of the best parts of this press conference when he said, look, if in the housing market, clearly it's restrictive, right? In financial markets, not at all.
Exactly, and I think that's why the Fed is not going to hike interest rates this year, because if you look at the housing market, interest rates are quite tight and restrictive. If you look at financing for data centers, it's a lot more liquid, easier. But when you look at the SEP, which we should take with a grain of salt at this point, that looks for rate hikes this year, but then looks for easing next year, it clearly is signaling a bit of caution, confusion about what's the appropriate monetary policy stance. And so when you have unevenness across the economy and not a clear consensus of rates should be higher or lower, stay the same, the best move is no move, in our view.
Well, it's always been the problem for the Fed of using a hammer or using a bazooka to hammer in a nail, or whatever the metaphor for that is. When it comes to rate hikes and rate cuts, it is a Kevin Warsh, a Chair Warsh, who's been much more concentrated on the balance sheet. How do you expect that to evolve?
Well, we have a task force for that that's going
so maybe we need to wait like a year to understand that.
There's been a plethora of research on how the balance sheet impacts interest rates, impacts financial markets, it impacts the broader economy. And the consensus is that it's not as simple as a blunt force tool like interest rates. And so, yes, this task force is going to revisit how we use the balance sheet as a monetary policy tool, but I don't necessarily think we could use the balance sheet to replace short-run interest rates, because there's so much more that matters across the yield curve, especially when we get to longer-dated treasuries like 10-year, 20-year, 30-year, besides quantitative easing and quantitative tightening.
What's your take on this K-shaped economy? And we really see it, every day when we have earnings that affect the consumer or that involve the consumer. We'll see amazing spending, for example. And even though we know it's difficult for the bottom 50% to afford gas and food,
right,
does that get worse in the next 2 to 3 years? Is there any way it gets better? It seems that the income inequality has only gotten, in my lifetime, worse and worse and worse.
So for right now, we look to the savings rate, which I think is really telling the story of the K-shaped economy. The savings rate is at historic lows. Part of that is low-income households really having to dip into savings to meet the cost of basic goods like food and gas. The other side is that high-income households are tapping into their wealth, that wealth effect, and that pushes the savings rate lower as well, because we are seeing that real income and real wages are negative now on a year-over-year basis because the labor market is a bit soft and inflation is high. If we look over the next year or two, I only see this K-shaped economy getting worse. Higher interest rates for longer are going to continue to push people out of the housing market, bearing the brunt of high rental costs. And then this AI build out, right? It's mainly showing up at this point through the wealth effect, which is going to continue to fuel high-income households. The other thing I want to mention is that we've done some research on how this AI build-out affects local economies, and we do see higher utility costs, higher home prices, and not long-term job gains. It's about 1,500 people to build a data center, but then only about 30 people to actually run a data center longer term. So I don't
Unless it's in space, Sarah.
Unless it's in space.
Because then you probably need more people to run it.
And then there's no NIMBYism of people being upset, like not in my atmosphere.
Yeah,
like
right.
it's fine. Yeah. Sarah, thank you so much for joining us. It's really been excellent. That's Sarah Wolfe, Senior Economist at Morgan Stanley Wealth Management. Let's get a check on your equity market about 40 minutes into your trading day. And we move higher, not yet at all-time highs, but we're on our way there. The NASDAQ outperforms up 0.75%, even though the Mag 7 is having a not so good day. It's all the chip stocks that are doing well. Micron reaches an agreement with Anthropic, and we get earnings from it later. 10-year yields, those keep moving higher, up 4 basis points as Brent crude falls 3.5%.
Let's get a look at some of the single stock stories that are falling for you this hour. SpaceX poised to fall for a third straight day. Shares were down when it announced its first bond sale to raise billions for its AI and space and AI in space ambitions. Chip stocks trending higher, with Micron also extending gains as we see SanDisk adding another 5% to its 4,000% rise in 1 year.
And then there's some deal news this morning. AbbVie is buying Apogee Therapeutics. It's a $10 billion deal that will expand its anti-inflammation product line. Coming up, we discuss Alan Greenspan's legacy with former Fed Governor Randy Kroszner. Stay with us for that. This is Bloomberg Open Interest.
Let's get to high interest liquids making headlines around the world. The Treasury Department is allowing the sale of some Iranian crude and petroleum products under a new general license following last week's U.S.-Iran memorandum aimed at ending hostilities. The move marks an early easing of restrictions and could help return some Iranian barrels to the global market. Morgan Stanley is weighing a $1.3 billion office tower in Dallas, bringing its growing local operations under one roof. The move adds to Dallas's momentum as a financial hub following big investments from Goldman Sachs and Bank of America. And former Federal Reserve Chair Alan Greenspan has died at 100 years old from complications from Parkinson's disease. Greenspan led the Fed from 1987 to 2006, overseeing what was at the time the longest economic expansion in U.S. history and becoming one of the most influential central bankers in the world. His legacy was later clouded, though, by criticism that lax financial oversight helped set the stage for the 2008 financial crisis.
Joining us now is Randy Kroszner, economics professor at the University of Chicago Booth School of Business, former Fed governor, and former member of the White House Council of the Economic Advisors during the Greenspan's era, during Greenspan's tenure at the Fed. Randy, great to see you this morning. And obviously, you knew Alan Greenspan, you had worked with him, and then you went to join the Fed shortly after he served. It's certainly an era steering us through unprecedented peacetime economic expansion and then recast perhaps in the 2008 crisis. How should we view Alan Greenspan's legacy?
Well, I think he was someone who contributed enormously to economic growth in the U.S. But obviously there's also the issue of, did he also contribute a bit to some of the risk-taking that led to the global financial crisis? He got many calls right. For example, he saw the productivity boom in the late 1990s and held back on raising interest rates. Probably ex post a very wise move that helped employment to grow more than it otherwise would have. And so, as with anyone who was going to be in policymaking for as many years as he was in, many positives. And unfortunately, one negative that's there that needs to be acknowledged.
That's the housing crisis, essentially. A lot of people argue that he led to, that he helped build leverage in the system that, ended up in the great financial crisis. Is that a fair characterization, you think? Because he did give us the great moderation, as Ben Bernanke called it.
Well, one of the lessons that he took from, let's say, previous crises when he was there during 9/11, if you look at the intro to his autobiography, The Age of Turbulence, he talks about how the lesson that he took from that was how resilient the U.S. economy was. His view was that a few words, comforting words from him and from the Fed, and maybe a judicious interest rate cut here or there, could get the economy back on track, even if there was a big shock. I think his view was primarily that the Fed could clean up after a crisis fairly quickly, fairly easily. And if the Fed tightened too much early on, it strangled the ability to grow, to innovate, and move forward. So he made that trade-off to say, let's have many years of growth and take perhaps a little bit more of a risk of some of that downside. But his view was that the Fed easily could clean that up. Obviously, when I was there, we did try to clean some of that up, but it probably had a bigger cost than I think he would have anticipated.
Well, one of the other big impacts that Alan Greenspan made was before him this veil of secrecy that the Fed operated in. Alan Greenspan brought into the era of the Fed issuing a statement after a policy decision was made. Randy, it feels like we are yet again putting under a microscope what it means, what Fed communication means at this moment with the new Fed chair, Warsh. Just how much has Fed communication evolved, and how much do you expect it to evolve yet again going forward?
It was amazing. It is hard to believe that the Fed didn't talk. You really knew nothing about what the Fed was doing. There weren't constant chatter on your program and other programs from Fed officials and former Fed officials. It was really a very quiet place. As you said, Greenspan introduced the first statements and then developing those statements further. What's very interesting is that Kevin Warsh, who served on the Fed at the same time I did, wants to move back to kind of the early part of the Greenspan era, where there was a much more simple communication, less forward guidance, although Greenspan did give some forward guidance. I think Kevin wants to go back even further back to something more plain vanilla beyond that. And I think he thinks that will help to push he and his colleagues to think in the big picture terms, rather than responding to every bump and wiggle in the data, every number that comes out. Try to sit back and have a bigger picture view of what does AI mean? What does the war in Iran mean? What do supply shocks mean? And try to convey that big picture to the market rather than trying to comment on every particular number that comes out. Because the Fed needs to look through that, needs to see what the bigger picture trends are, and needs to have a stronger view. So I think that's how things are likely to evolve going forward.
Randy, how do you talk to your students about the Greenspan era and this whole kind of Austrian school, Milton Friedman, Ayn Rand vibe of libertarian economics, where government intervention is seen as a bad thing, and gold would impose discipline on governments, and the whole sort of economic freedom tied to political freedom, this whole philosophy of Alan Greenspan?
Yeah, it's very interesting that he started. He was very much influenced by Ayn Rand, and he talked about gold as sort of the only sound money. When he was at the Fed, we didn't hear quite as much about that. I mean, he certainly was a sound money person, but I don't think he thought that gold was the only way to achieve that. And I think he had a very strong view on the health of markets, the importance of markets, the importance of competition, and those shouldn't be forgotten. But also, we know that sometimes things can get a little bit out of control, a little bit out of whack, and some of that is unintended consequences of regulation. So, making sure you understand that yes, there's a safety net that's there, but that safety net can have some unintended consequences that might not be so easy for the Fed to clean up afterwards, is something that I think is an important qualification that comes in. He also talked about this a little bit in his testimony that he gave after the global financial crisis. He said there was a flaw in the system, and what he meant by that was that he thought that if people have their money on the line, they're going to do full due diligence and make sure that money is well allocated. Unfortunately, one of the things that we found out, and certainly Alan Greenspan talked about in his testimony, was that's not always the case. Sometimes people are not as careful as they should be, and if people are not being as careful as they should be, there's not the due diligence, and so bubbles can arise, problems can arise that can lead to things like the global financial crisis.
It's something that his wife mentioned in the statement she gave when Greenspan passed away, that he was always honest in acknowledging his mistakes. Randy, you also mentioned that part of the other part of Greenspan's legacy was allowing the economy to run hot in this 1990s internet era boom, even not hiking rates. And allowing unemployment to drop without doing so. I wonder, is history any guide there to this period we're currently undergoing?
Well, it was different because inflation was much lower at that point. We didn't have, just in the last few years, a high inflation coming into that. So I think the context is very, very important. But I do think there's an important lesson there, that the Fed, once again, shouldn't be just focusing on just the short-term movements of some of these numbers, but think about the bigger picture. What are the key things that are going to be driving the labor market? What are the key things that are going to be driving economic growth? And take those on board and not overemphasize the short-term numbers, but have a clear view on the bigger term, on the bigger picture. And clearly that's one of the things that Kevin has been talking about.
All right, Randy, great to get some time with you. Really appreciate you jumping in with us, and our condolences, of course, to you and everyone who knew Alan Greenspan. Well, one of the most influential Fed chairmen who ever lived and ran the central bank for nearly 2 decades has died. He was 100 years old. This is Bloomberg Open Interest. Let's take a look quickly at the Japanese yen as it tests the highest level that we've seen in years. Here is the single day view right now at 161.75 yen to the dollar. You can see we've come off the highs, which really are lows. If you look at the inversion there, that's the amount of yen you can buy for $1. And here's a look over a year, but if you bring it out to 5, you can see that we have gotten close to the level that we put in the middle of 2024. I think that was the July 2024 high. So waiting to see if some central bank intervention is to come. I think the market expects that, but what can the Bank of Japan really do if the currency is in a structural decline? Coming up, Alamos gold shares drop after the miner cut production. We'll speak with the CEO, John McCluskey, next. This is Open Interest.
Gold prices are still holding near record highs, but Alamos Gold is facing a setback today. Shares are down sharply after the company cut production guidance following disruptions at its Young-Davidson mine. For more, Alamos Gold CEO John McCluskey joins us now. John, great to see you this morning. Let's just start with that. What can you tell us about the disruptions and how it alters your path for production?
Well, we had a seismic event at our Young-Davidson mine. In terms of order of magnitude, not the highest that we have experienced there, but it happened to affect an area where we were actively mining, and as a result, we're pulling back on our production rates for the balance of the year. It was a localized event. It's not affecting the whole mine, just one part of the mine. So we're still able to operate at around the 5,000 ton per day rate. Relative to, we were doing about between 7,200 and 7,500 tons a day. So the mine will continue to operate. We expect to rehabilitate this area and ultimately get back in. We're not forecasting to do that before the end of the year, but we expect to be back to normalized mining rates in 2027.
It's amazing how hard your stock has been hit this year. I mean, you were up at one point a massive amount. I look at a 5-year view. At one point, you were up 600%, and now that gain has been halved to a 300% gain. I'm curious to know how you deal with seismic events. I mean, can you be insured against that kind of activity, or is it considered always a force majeure, or what's the story with that?
Well, seismicity is just a normal part of mining operations. It's not like an earthquake in Los Angeles or something like that. We cause the seismicity by our mining activity. It's actually the blasting that we do on a daily basis causes a relatively small amount of seismicity. It's actually a healthy thing. It's just the rock settling before you go back in and mine. But from time to time, and this has been the case in the particular area that we're in, you can get a bit of a heavier reaction to that blast than you would typically experience. And in this case, it seems to be because of the presence of a nearby dike. So an area within the overall ore body where we don't have any mineralization. It's sort of it's something that comes in after the ore body had been in place. So they call it a post-mineral dike. And the dikes themselves generally don't have much of an impact on what we're doing. But in this particular case, the presence of the dike and proximity to the stopes that we're mining seems to have been the cause of the higher intensity of the seismic shake, if you want. And it's something that we can rehabilitate, and it's something that we can deal with.
I just wonder on that. So you can rehabilitate it, but for now you get this short-term price impact to your share prices. Have you had some calls to you lately saying, hey, John, maybe you want to join forces with us? Do you think this makes you somewhat of an M&A target at the moment?
Well, I don't think M&A typically works like that. It's a bit like, you don't approach somebody when they're going through a temporary problem and say, well, let's.
But you do maybe when prices are down, because maybe it's more attractive to shareholders to get bought out.
Well, I would entirely disagree with that. I think that when things are going really well with a company and you're looking at a much fairer valuation for your shares, that's a better time to be discussing anyway M&A. But in any case, we're a company that's growing. We're not a company that's looking for a buyout, and that's always been the case. People have been talking to us about being taken over since practically I started the company back in the early 2000s. I remember when we first hit $100 million of market cap, people thought, oh man, you're 10 times higher than where you used to be. You must be looking for a takeout. Well, we're a multi-billion-dollar company now, not a $100 million company anymore. So, we have much bigger plans, and while Young-Davidson is an important part of our production profile, our Island Gold Mine is where by far the big value in the company lies. More than half of our, I would say right now, at our current market capitalization, you could almost hang the entire value of the company on our Island Gold Mine. And Island Gold is a very, very rare asset zone, one of 3 mines of that caliber in all of Canada. We're only non-major company that owns a mine like that. And it's growing rapidly. We're expanding production there. We're heavily investing in that asset to achieve that, to essentially increase production and lower our costs. And by and large, that's where the focus of our growth has been. Our YD mine is, over time, it's been a very good producer. It's been a very profitable mine. But it's not exactly a growth story. It's been one where we've sort of been maintaining production, and we've got a fairly large reserve there. We've been mining it since 2015. We've got reserves that'll take us out towards the end of the 2030s. YD's going to be around for a long time. It's experiencing a temporary setback, but it'll be relatively short-lived, and I expect to be back at normal operations in 2027, if not before.
Well, be careful that Dani doesn't put together an investment group, John, and try and take you guys out at $30 a share. John McCluskey, the CEO of Alamos Gold, talking to us about his business. Fascinating stuff on the seismicity there. Let's get a check at what's going on in markets right now, because we are seeing the S&P turn around and come back down. Just 13-point drop to 74.87, but that compares to a gain of more than 20 points earlier. So we're seeing a reversal. The NASDAQ itself unchanged as those chip makers fail to give it the boost they were in the early trade. The 10-year yield still up almost 5 basis points. So 450 is a level you're looking at there, and it's catching up with the gain that we saw in the 2-year this morning as well. So rising yields across the curve. Brent crude down now 3% at $78.15 a barrel.
Some of the single stock movers that we are looking at: SpaceX, it drops for a 3rd straight day with declines as much as 10%. Today, they said that they will be selling investment-grade bonds for the first time to fund its AI ambitions. Originally, it rallied about 50% in the first 3 trading days. It's about halved those gains.
All right, Chevron signed a 20-year deal with Microsoft to provide power for a West Texas data center that opens in 2028. We were talking about this earlier with Ed Ludlow. It's going to be almost 3 gigawatts of power there.
Some other deal news: CRH agreed to acquire U.S. construction services company Arcosa for $8.5 billion. It's a record deal for the Irish building materials provider.
Coming up, AI changed how we shop online. Now Upside says it can do the same for brick and mortar operations like gas stations, grocery stores, and restaurants. Alex Kinnier, co-founder and CEO, joins us next. This is Bloomberg. Gas prices may be falling, but it could take months to return to pre-war levels. Meanwhile, consumers are still feeling the squeeze every time they shop for groceries or stock up on essentials. At the same time, retailers are battling rising costs and shrinking margins. We're here to talk about how technology could help bridge that gap. For both is Upside co-founder and CEO Alex Kinnier. He previously led Google's large advertiser ad platform team. And Alex, it's great to have you in the studio. I hear these Upside commercials all the time on Bloomberg Radio, and the idea basically is if you use this every time you fill up, you can get back literally $200 or $300 a year. First of all, is that true for the average user like me? And how can you afford to pay people just for downloading the app?
So it's 100% true. In our gas markets, that's a very average number to be able to achieve. But if a household uses us for gas, groceries, and restaurants, they can easily earn up to $1,600 a year. And it's a free app. They download it, like you said, they see the offers and they can claim them. How it works is that retailers are out there. They're working to, let's take the #1 share grocer in St. Louis, Schnucks. 30% share is a phenomenal position to be in. What that actually means is 70% of the transactions they're not getting. We find that transaction and bring it to the retailer. And we do that through that personalized discount you talked about. And if we drive proven incremental profit to the retailer, we get a percentage of that profit. Our only revenue stream is that profit sharing, so the consumer and the retailer win.
You must be sitting on like one of the most fascinating troves of data right now in all of America, because it is this conundrum of it's a K-shaped economy, but people are still spending, but gasoline prices have been moving higher. What have you seen? How have consumer sentiment and behavior evolved over the past couple months, especially since the Iran war has started?
So, stepping back, the median household is strained. They're working to make ends meet on a daily, weekly basis. And so when gas prices go up, you see them shift behavior. So they're dialing back on restaurants, they're trending down in their decisions in grocery. And what we saw was the amount of gallons per fill was going down. That's a person trying to make their daily budget work. When gas prices go down, it's counterintuitive, it's not relief. It just makes it so that their spending patterns can go back to what they were. They can make less sacrifices. So it's definitely stretched out there.
But, I mean, to Dani's point, my first thought was, wow, if an economist had access to your data, that would be really cool. But then I also thought you could sell that data. Do you do that? Can you make money selling the data?
We probably could, but we do not. So we sell.
I mean, you don't have to attach people's names and identities to it. You could still sell it as
anonymized.
No, so we exist 100% to serve our retailers and our consumers. And we don't sell any consumer data and we don't sell any retailer data. We only have one way to make money, which is if we can drive an incremental and profitable transaction to a retailer, which means a consumer saved an outsized amount because they made a purchase and the retailer earns profit. That's our only profit source. But yes, we see really fascinating trends like these changes in behavior I was talking about.
Are retailers also still increasing the prices of things? And I guess maybe that's better for you because you can also help in and step in and give discounts to consumers. But, you know, post-COVID in that inflationary environment, we saw retailers say we raise prices, and consumers will still pay. Are we still in that environment where they can raise prices and consumers will still pay?
Definitely not. The consumer is strained, and the retailers that we work with, again, about 20% of U.S. gas stations, approaching 20% of U.S. grocery stores by the end of the next year, they are working to pass on as little as possible. And so they're taking it in margin, and they're finding other ways to save money.
How much growth have you seen? Because you started out, or at least I first heard of you on the gas station side. Now you obviously have moved heavily into the grocery side, and restaurants, I guess, are on the horizon as well. So
that's right.
What kind of growth are you seeing?
Yep. So we started in fuel. We started there because everyone buys it. And we need to learn how to do this personalization, improve incrementality. When we put a grocery store in, some interesting things happen. Those consumers start purchasing grocery. And so retention on the app goes up 2x and revenue goes up 3x per user. And so since our last funding round, we've grown about 44% on a compound annual growth rate, and that last funding round was in 2022.
By the way, so the digital side is easy to see, right? On my Instagram account or on Facebook or whatever, right. I get an ad that says like 15% off the first, you know, I don't know, Sendero Provision shirt you buy, right? And then I enter my email address and I go and do it. For the brick and mortar stores, it's not as easy to do that. And I guess this is a solution that you come up with out of Google.
So that's exactly right. So brick and mortar retailers are sitting on tremendous amounts of data, tremendous amounts of transaction data. But they have a hard time understanding it down to the consumer level. We think of ourselves as a digital layer that makes that interaction more economically efficient for both the consumer and the retailer. Our consumers give us explicit permission to take the anonymized transaction data and find their transaction within that so that we can give them that value back.
So gas, groceries, Matt mentioned expanding into restaurants. Where else might you find yourself in the future?
So we see ourselves being able to serve and for all brick and mortar commerce. So think about home improvement. Think about the stores in the downtown area of your choice, the ice cream shop. Today, we're most focused on grocery, and that is our major expansion right now.
And AI, I guess, you don't look at it as a competitive threat. You look at it as something that enables you to do better.
Yeah, so we've been using AI to find the optimal offer that finds that transaction the retailer isn't getting today. Bring that consumer outsized value, and then bring that consumer to that retailer so the retailer profits. We've been doing that for many, many years. And our algorithms are just getting more and more advanced to do that. But like every company, we are finding really interesting new ways to use AI, and you mentioned those radio ads. So it used to be that you created one radio ad and you ran it hundreds of thousands of times. Not very personalized.
Right.
Today, using AI, we're able to create hundreds and hundreds and hundreds of thousands of spots that are run one time. And it's hyper-personalized down to a city, a retailer, and an event. For instance, it's going to rain tomorrow, it's going to snow tomorrow, or this football team just won their, the high school championship in your area. Go to this restaurant to earn something. And so that hyper-personalization is now only possible because of AI, and it's allowing us to provide even better results, higher ROI for our retailers.
Do you need to hire more people to check it? Because what if it hallucinates some football game that never happened?
QA is extremely important, and yes, today we have a lot of humans in the loop, that's for sure.
Interesting. Alex, thank you so much for joining us.
Thank
we appreciate your time. That's Alex Kinnier of Upside. Coming up, the U.S. wants to end its dependence on China for critical minerals. China is not making that easy. We discuss next. You're watching Open Interest. Time for our metal spotlight, and China is imposing export controls on 2 U.S. rare earth companies, saying the move is necessary to safeguard national security and interests. MP Materials and USA Rare Earth say that they have largely been cut off from supplies from China. Joining us now is Bloomberg's Joe Doe, reporter covering corporate and economic statecraft. Joe, thanks for joining in. It's been months, at least since that October summit with Trump and Xi, since we've had China use some of these tools in order to punish American companies. What brought this along?
Yeah, listen, what brought this along? I mean, earlier this month, the U.S. announced a ban on certain Chinese companies from receiving certain technology from the U.S., claiming that they were companies supplying the Chinese military. I think there's a way to boil this down, right? It's easy to get caught up in the weeds of this and that and tit for tat. And like you said, we have not seen any action since the truce that was reached in November by either side of the United States or China. The announcements earlier this month by the Pentagon obviously were used as a reasoning by the Chinese ministry to impose these export bans on MP Materials and USA Rare Earth. I think what it's really telling us is a reminder that this truce ends not too long from now, and nothing's been done about it. And I do think on some level it is China reminding the market the chips that it holds. And, listen, there's a number of people that I've talked to have said this is largely symbolic, right? MP Materials and USA Rare Earth, they're not significantly dependent on equipment or materials from China, but it does put in the spotlight the two main U.S. rare earth companies that Donald Trump and the U.S. federal government support. And so I think it is largely symbolic, but really sends a political message here.
There's a great story, Joe, about the winners and losers in President Trump's new tariff wall that he's sort of rebuilding after the Supreme Court decision. And one of the points they make is that China is going to have much lower tariffs than it did initially after Liberation Day. And precisely because of the fact that they withheld some rare critical minerals and rare earths, and we realized how important it is that we, in some sense, appease them, right? Do they still have that incredible power, or has the U.S. made any headway in finding other sources of these materials?
Yes to both. They've made some headway, right? Like real money has gone out the door to support development of a domestic and nearshoring supply chain of the rare earth supply chain network. But China still has a massive cudgel in this whole thing, right? This has been a reminder. Like when the announcements came out last year after Liberation Day, right? That China was putting export controls on 7 new rare earths, critical minerals, and equipment. That was, as many people told me, like the beginning of the tech war. That was a cudgel that many people, even in the prior administration, had told me, we were always worried that this is the thing that China could go to. We were surprised that they did it. And I think since then, the entire government, and not just the entire government, but people in the supply chain, defense prime contractors, right? All of them now see that China has been willing to use these export controls on rare earths to send a message to the United States. It's still there. This announcement today makes it very clear that it's still there. Now, I'm not saying that this is like an end-all moment, but it is significant and it is serious, and it is one of the ways that China has been able to fend off this massive push by the United States to put even more onerous tariffs on China. And as you pointed out from this person saying the biggest winners and losers, that's absolutely correct.
Joe, thanks very much. Bloomberg's Joe Doe talking to us about critical minerals and rare earths in our metals segment for the day. We are looking right now, well, at a trading diary here. You get PMI data tomorrow, then you get a wave of other economic data that maybe isn't as interesting. We get earnings from FedEx and Micron on Wednesday.
That'll be interesting.
Yes. Then Thursday, PCE data, which any economist worth his salt can figure out.
Yeah, but maybe it's hot, and then we freak out again like we did last week after the FOMC.
We usually know precisely what it's going to be. And then sentiment data from the University of Michigan.
Which maybe doesn't
really say anything.
It doesn't matter. A check on markets this morning, about an hour and a half into your trading day. Just want to point out SpaceX falling 10.6%, almost 11% this morning. The entirety of the market has turned. We're now down 0.5% for both the S&P and for the NASDAQ. So sentiment is flipped, and this certainly not helping. Coming up tomorrow, State Street strategist Maria Whiteman, PNC CIO Amanda Agati, and the Oklo CEO Jake DeWitt. This is Bloomberg Open Interest.